Hi, this is Randy Finney with the right side of the chart, and today is Sunday, October 16th, 2016. In this video, we'll do things a little bit different. I'm going to keep it pretty simple. It shouldn't be too long. I will focus only on one time frame in this video, the daily time frame, and just take a look at the major U.S. indices. And we'll break it down into really two parts. I want to just take a look at the trend indicators, and then take a look at simple price, looking at trend lines and things like that. And again, I won't get too in depth. Everything has been covered in detail recently, so I want to keep this simple and just try to drive home the big picture here, what we're looking at. Now, starting with this chart, this is goodness, how far back? This is at least a decade here, a little more. Yeah, 10-year chart. And it's one of the trend indicators that I use. There's many out there, but I have different trend indicators for different time frames. One of the trend indicators on the daily time frame that I like to use is a pair of the 20 and 50-day exponential moving average. And so what we're looking at here on this chart, you can see the two lines up here. In the very corner, you can make out EMA 20, EMA 50. So you have the red lines of 50 EMA, the blue lines of 20. Now, it can be hard to see, especially in a video, where these lines cross. And essentially, when they cross over, those are what you refer to. They're commonly referred to as a golden cross or a death cross. A golden cross is bullish, and a death cross is bearish. So when you have the faster moving average move up and above the slower moving average, that's a golden cross or a bullish cross. And what I did is, this chart will look busy, and the next few won't look so busy. I have a lot of lines here and just indicating every time those two crossed. Now, what I do to make it a little clear is I customize a histogram down here that simply shows the 20 and the 50-day moving average when they are above and below each other, or I should say when the 20 is above the 50 and the trend is bullish, the histogram will be green. So when it crosses down to this, I guess, brown color that I have here, that's when you have a bearish crossover, or a bullish cross when you see it turn green. So you can see how the lines just line up, these horizontal lines line up with the crossovers. Now, take it down below. This is a chart of the S&P 500. So what I wanted to point out here, and again, keep it somewhat simple, I have all the whipsaw indicators are in here. Whipsaw signals are when you have two of these lines in close proximity. As I often say, nothing in technical analysis or trading or investing is 100% perfect or accurate. If it was, we would all be retired. We'd have that magic formula, the magic bullet. The markets are dynamic. Anything that works for some time tends to work for a little while and then stops working. And some indicators work great in certain market conditions and others don't. Now, my takeaway from this moving average pair is this. I went back 10 years here to show you this period encompasses both one of the worst bear markets that we've had in really the history of the markets, as well as one of not the strongest bull markets. The bear market from the highs in October of 2007 into the lows of 2009 was one of the worst on record. Very vicious bear market. Doesn't really show it here because I wasn't able, on stock charts, I have the price down below and I have the moving average pair up top. Therefore, they won't let me set this in using log scaling, which would make this drop more proportionate to this big rise. You can set the log scaling up on top. So in other words, I couldn't flip this chart around the other way, but just take my word for it. This is a big drop. I can tell you this drop here, I think, was about, from when we had the crossover signal, about 15%. And this one was about 50-something% from when we had the cross. So here's my takeaway on this. This trend indicator, as well as some of the other ones on the different time frames, I won't get into the other ones right now, it works great. Is when confirmed, it works best when confirmed and used with the primary trend. What I mean by that is, okay, you had a bull market back here leading up to the 2007 highs. There's the peak back in October of 2007 right here. From this point, we had only two sell signals when the 20-day moving average crossed below the 50. It was right here and right here. And that, by far, captured the bulk of the two largest. There were two primary downtrends you can see here in the bear market from 2007 to 2009. So this was a primary downtrend. You had a couple whipsaw signals leading up to that, but if you got short and stayed short through most of that, and another thing, I don't want to digress too much, but I don't use these as standalone buy and sell signals. When you get down here to the bottom, I could all but assure you there were divergences on the 60-minute chart, support, other reasons to go long and probably get out before that signal actually crossed over. But with that being said, even if you just traded the signal by itself, you caught the bulk of the trend. At this point, the lines crossed over and there was an uptrend to be had. By the time that the signal goes back to bearish, some of you give up some of the gains, but then it was bearish, and again, leading into the lows, caught the biggest leg down, kept you short or out of longs for the majority of that final meltdown phase, which was, I think, from that signal, I think if I remember correctly, it was about a 55% drop into the lows. Now, this begins a new bull market in March of 2009, March 6, I believe it was, 2009 is when most of the markets, including the S&P 500, bottomed. And now, so as we all know, we've been in a bull market since. So what's my takeaway from this? The green arrows show you the bulk, the most powerful trends. If you look at the most powerful trends in the market, it wasn't a straight right up, it never is, but these trend indicators would have kept you long through the bulk of the primary trends up. Again, screenshot this one. I've put it up in static form, or just simply replicate this chart on your own, a 20 and a 50-day moving average, and look when they cross over. And again, it can be busy, if you look at all the lines and saying, well, gosh, you got whipped around, and there certainly are some whipsaws. But again, my takeaway is, as I often say, an example I'll use, I often say that oversold in a bear market is typically not a buy signal, because oversold can become oversold for an extended period of time, or an oversold reading on the RSI can become much deeper, much below that 30 level. However, in a bull market, oversold readings, my experience on just about any asset, especially in broad markets, those tags of 30 are very fleeting, and they prove to be great buying opportunities in bull markets. Likewise, in a bear market, overbought, which is a reading of 70 or more on the RSI, those readings are very fleeting in a bear market, and if you get them, that's usually a great chance to go short or sell out of whatever longs you were in on a bounce, because overbought doesn't stay overbought very long. And that's the analogy I'm trying to use, is when you're using this trend indicator, if the primary trend is bullish, then these are great signals, especially to catch the bulk. And these, here's that most powerful trend we had right there was from, it looks like late 2012 into the end of 2014. And this trend indicator would have clearly, you can see, look at the histogram up top, clearly kept you long throughout that. This one wasn't a very strong uptrend, yet it was, the market moved mostly sideways, but the trend was up and it still kept you long, and there were a few recently. Now remember, the last couple years you're seeing a lot more lines because the market's had this toppy action. It's been very choppy back and forth, and we're really right back to where we were a couple years ago in the market. So we've gone nowhere, but we've had some pretty big rides in between. Now, where I'm going to wrap this up with, is right now we've had a crossover. If you look, you can just make it out. You can't see it in this video on the histogram. I can when I zoom in on my larger monitors. This chart is only on a small portion of the monitor I'm using for the purpose of this video, recording the video. However, you can see negative 1.84. I can tell you that the lines have crossed. The 20 EMA recently crossed below the 50 on the S&P 500, and I'll hit on the other indices real quick. One more point to drive home. I have this also in a much longer time frame. You can go back. Remember, bull markets in economic expansions, on average, they run about 4 to 7 years, somewhere in between there. We're already on the very tail end of the long end of any bull market or economic expansion. So what I'm getting at is, sooner than later, one of these signals is going to stick and play out to really catch a good downtrend, and I've made the case on weekly charts, some other things out there in the market, that we could be looking at a very substantial correction. So I wouldn't count on this being a whipsaw signal right now. And by the way, this arrow is supposed to be green right there, that red arrow catching the uptrend from there. I just wanted to point that out. So there's the S&P 500. Again, busy chart. Let's look at a few more that are a little more clean, and then we'll wrap this up. Okay, just like the S&P 500 is a fairly diversified index. It is all large cap stocks. This is one of the most diversified out there. I talk about it often, the Wilshire 5000 composite. And I've gone to a little bit shorter time frame. And what you see on this chart, these light gray dotted lines are what I call whipsaw signals, where this 50, same indicator, we're still looking, and I'll stick on this until we look at the trend lines on the, go to the price action and trend lines. But 2050 histogram, you can see a whipsaw signal. By whipsaw, we told you to sell, and there certainly was a drop. But by the time the signal went back to a buy signal, we were right about, if not just a little higher than where we started. So I really view that as a whipsaw signal. Although, you could have taken it as a short sell signal. And I can all but assure you, if you go back to on the site, you'll probably see reasons we were covering shorts or going long there, such as 60-minute or daily divergences or key support levels being hit. But either way, you can see the bulk of this uptrend. Look throughout, this goes back into 2013. The trend was bullish. We had this one little whipsaw signal, and even if you were just trading this alone, let's just say you forget about trying to time the lows with divergences and everything else. So you got out there, or you got out of your longs and you got back in there. So you bought back in a little bit higher, but you've caught almost the entirety of this trend here because you avoided these losses, bought back in slightly higher. Then at this point you had a sell signal. So let's say you stuck to your rules, you followed it. You can see that histogram stayed. I put a whipsaw here. It was bearish. The Wilshire dropped. It did go green. So, if you were just trading off this indicator alone, you would have went long here. You would have went long, and then you would have sold back out here. So you lost a little bit on those longs, but you would have got short again or out of your longs again if you don't short. Bottom line is from here to here, you can see that, if you consider this a whipsaw signal, which it pretty much was, it caught the bulk of that downtrend. So here was the uptrend, there was a downtrend, and then it triggered a buy signal with a cross of the 20 above the 60 back here, and at the end, it looks like the end of March 2016, and has remained there all along. So it's kept you long. Very simple but effective trend indicators. And again, nothing's perfect. There are these whipsaw signals. I use these in conjunction with everything else once again. And right now, as I said, we already have breakdowns on almost all the U.S. Actually, all the U.S. indices have broken down below their trend lines. So they're on sell signals in my book. And what I'm looking at here is confirmation coming now on these trend indicators, which only make those sell signals more powerful. The Wilshire has just a hair to go, another day or two, one or two big down days, and you'll have a crossover with the 20 below the 50. So as I just mentioned, we already have that crossover on the S&P 500. I just showed you, even though that was a longer chart, it had a lot more signals. So there's the Wilshire ready. Okay, I accidentally hit the pause button on the video, so I may have gotten cut off there. This is the Russell 2000, same trend indicators for 2050. This is also going back just a few years, a 3-year chart. So we're going back the last 3 years. And you can slight little whipsaw signal there. So brief and fleeting, it only lasted maybe a few days or a week or so. But the red lines show the sell signal. So here was your crossover. And again, whipsaw, whipsaw, whipsaw. Bottom line, if you got out there and you stayed out, you can see that once that trend indicator went green and stayed green, once the averages, clearly this was a choppy sideways trending market. And that's when trend indicators don't work. I often point that out. I pointed that out recently on my 60-minute trend indicators, because this market was in such a sideways trading range. When you have them crossing down and hovering around the zero level, I'm talking about, on this trend indicator, this histogram, the zero level is where they cross. That's when you stay away from it. However, once they cross and make clear separation and the market begins to trend, now you're in an uptrend. And as you can see here, from this point, those lines crossed and remained bullish with the 20 above the 50 all the way to this point. So in other words, you caught, it defined this whole trend right here. I actually meant to use that with an arrow tool. Define that trend. This was choppy sideways action, we'll call it. It was bullish all along here, and to the left of the chart, the trend was up. And then the small caps had a huge correction. They topped out back in 2015 right here. And you can see this trend indicator got you short and kept you short or out of the market, out of longs, or at least in the small caps for the majority of that correction. Here it went green and stayed green. You can see that histogram showing, the taller the histogram, the bigger the separation between the two lines. And so that trend has been bullish since. Now what are we looking at? We don't have it yet, at least not by this trend indicator, but that look at that 20 MA. It's turned down and it is pointing straight down. And it would take a pretty good snapback rally right now and a reversal in trend. The meaning the small caps would have to move up, consistently for a few weeks to prevent a crossover here. So right now we're looking at a pending crossover. And I already told you we have a confirmed crossover on the S&P, which is much more important. When you look at the small caps compared to the S&P 500, the S&P 500, those are your large mega cap blue chip companies. That's a much better indication how the economy is doing, and that's where a lot more money is in the S&P 500. So that's a more important index. Okay, just two more on the trends, and we'll move on to price. And price will only take a minute. Won't be done with this video. All right, this is the mid caps. Mid caps are more important. They're larger than the small cap index. Meaning the market. It's larger market capitalization in those companies. So the mid caps, as the name would imply, lie between the small and the large caps as far as the size of the company or the market cap in those companies. And again, just not perfect. We're going back 3 years also. You can see the histogram green, meaning the pairs were bullish. These dotted lines are the whipsaw signals. I acknowledge there are some whipsaws. And then you had this downtrend here, and that was a pretty sharp correction. Maybe a whipsaw signal, call it that if you want. Essentially it was if you were only trading just the crossovers. But there were other things that may have gotten you out during that correction right there, out at the bottom if you were short or back into longs. However, once we crossed here, there was a nice uptrend. And again, the theme here is these pairs do a great job of defining the intermediate term trend. There was a downtrend with a brief whipsaw signal, and since there we went bullish, and it has been bullish, kept you long throughout this advance in the mid caps, and most importantly, most recently we have a bearish crossover. You can see the value there, negative 2.57. If you can't make out the histogram, it is red. Again, if you had to do this on your own charts, you can see that histogram a little bit better, or just put the moving average pairs up. You can see that the 20s cross below. So there it is, guys. The S&P 500. Wilshire's ready to cross. We had most of these on sell signals. The only ones that haven't or aren't very close, or the only one I should say, and I think you all know where we're going with this. And that would be the almighty NASDAQ 100. I keep mentioning, and I think we're all aware of it, there's just a handful of stocks, the Amazons, the Facebooks, the Microsofts of the world, that are holding up the weight of this entire market. And we have everything else, as I showed you. Even this one has broken its trend lines, but as far as a trend indicator, we've had a few whipsaw signals. Again, they're marked by these little dotted lines. There was a couple pretty hefty corrections that this trend indicator would have gotten you out. However, the NDX remains pretty comfortably above the histogram remains solidly on a buy signal. But as I often say, the stock market isn't any one index. It's not the strongest index. It's a collection of all the stocks out there, small, medium, large. We're going over just the U.S. markets here because there's really not time. I'll do separate posts on the other markets. So that's it. So we have the rest of the just about a very solid case for a substantial correction in all the other markets. And remember, these trend indicators, they lag, especially the longer you go out. I have trend indicators on the weekly charts, monthly charts, and they have very few, if any, whipsaw signals. The problem is it's almost like the government data. By the time we're in a recession, You're going to hear about it long afterwards because the government has never ever come out and declared a recession, because that data is always revised. You get the revisions that come in months later. So every recession we've ever had has only been identified in hindsight. And the same thing's going to happen if you're a trend follower. You're trying to trade these trend indicators by themselves, especially the longer ones like my weekly trend indicators that are very accurate, have much fewer whipsaw signals. However, you need to use these shorter term trend indicators to kind of get an idea. And one thing I look at too, and it's not drawn here, I look at things like divergences on these histograms. You can see we have negative divergence with price moving higher. We see the indicators rolling over. That tells me a likely trend reversal is coming. You can see the divergence there. It works, just as well on the histogram that I've created for these moving averages as it does other things like the RSI and MACD. So this one, what we're probably going to see is a flashpoint at some point when those leaders pop, and everyone decides, and the funds decides it's time to dump Amazon, it's time to dump Facebook. These valuations are getting out of hand, or for whatever reason, the market needs a correction. You're going to probably see the NDX lead the market on the way down, just like it led it on the way up and held the market up for a while. Okay, and to wrap it up, this part will be quick. These are just simple. I've put some clean boards, I call it, of my charts. They don't have all my targets and annotations, other trend lines. I'll give you those. I'll post those in static form. But here's the levels I'm watching, what I call the salient levels, the most important technical levels right now. You have the NDX with this bearish rising wedge pattern, confirmed with divergence. Same story on every index. If I don't mention the divergence, just look, it's down there. So you had the divergent highs. You had a breakout. These 2015 highs right here, you got almost a double top high. That was significant in the NDX. It broke out. Now, again, it's the strongest index. It's holding the market up. It came back in. It violated those highs once, took off. Now, healthy price action would see. And if you guys recall, if you follow the site, I predicted even when we broke out that we would come back in, not only back test the highs, that my prediction was that we would come back in below the recent highs, because that's normally what happens on a back test. It's just almost too easy to come in and just back test that 2015 high. So that's what happened. Now, I said my most bullish case would have been that, back test, the failure, I should say, of those 2015 highs, but then to rally back above. And if this market really had some legs at that point, it should have just taken off from there after making its back test. That hasn't been the case. Right now we're on back test number 2 of the 2015 highs. We just back tested it. I have an alternative trend line here. You can see that also came in. That comes off the lows back here in early 2016. So I'm watching this as an important level. It's price support. It's it defines the bottom of that trading range. I think it correlates with that. What is that? 116, if I remember correctly, level I keep talking about on the QQQ. So if and when that goes, boom. Now, from a simple point of view, we had a breakout. It was impulsive, big red candlestick, a breakout, came back in. We hit support. That was support. There's no big surprise at 116 level on the Qs, as well as those 2015 highs, which is about 4750 or so on the NDX, and we had a reaction. That's all that is so far, is a reaction. If we go back up and we back test the trend line, which is a possibility, that would be my most bullish scenario. But if we blast through there and take out the highs by a fair amount, and if we go to back test, remember, we'll just have a margin. We could marginally take out those highs, those previous highs. But that's what I'm looking at right now. A breakdown of a bearish rising wedge pattern, confirmed with negative divergence, and really to get I think if we break this level and these others that I'll talk about here in a minute on the other indices, then I think that's where the waterfall selling will kick in. So for the NDX, look at a move under 4750 or so, and again, not a tick or slightly just limping below their intraday. I'm talking an impulsive break, high volume. You'll know it when you see it. SPX. There's the S&P 500, bearish rising wedge, negative divergence, very clean trend line, breakdown, soon back out. There's a 2015 high. So, as anticipated before, or as expected, we came back in. and we more than back tested. We came in a little bit lower, and you can even see support here. I thought I had that added. Wrong trend line. Let's get rid of that. That's not even a trend line at all. Let's put a trend line right here. See this level? We had a reaction, reaction. That's where we back tested. And if I'm not mistaken, that's what I called for. That was the level I was looking at for the back test after the breakout to new highs. Now what happened is we hit it. We should have blasted off, but we didn't. It just doesn't seem like there's any fuel left in the tank in this market. We broke down again, and we're testing that level. That level's 21, call it 2120, give or take, on the S&P. That's a key level. If and when that goes, that will, especially if it corresponds with that level I just talked about on the NDX, that's what I call my lights out level. Right now we have a breakdown and a back test, so we're already back testing the uptrend line on the S&P 500, or the bottom of that wedge. A couple more and we'll wrap it up. Mid caps, MID or dash. Mid cap, clean bearish rising wedge, 2015 highs already failed. We took them out, came back under, tried to get above it again, and rolled over. So the mid caps to me look cooked. I have this trend indicator. You guys know I like watching that 9 EMA, the white line, the second of the two to cross on the MACD, and that has been in bearish territory. This is a bearish trend indicator for me when that's below. As you can see, it was back here. When it crossed back here, that tells you that the mid caps are now in a downtrend. And this is a very clean wedge. Look at all the reactions recently. So, I mean, TA 101, technical analysis 101. There's a breakdown, a little back test, and prices rolling over. There is a little support here, and like everything else, we just need to take out those recent lows. And if it happens on the mid caps, it'll probably happen on the S&P 500 and the Nasdaq as well at the same time. And look for that. And that again, to me, barring some crazy stick save by the Fed, and I know everyone thinks that Yellen will, can perpetually hold this market up. I can tell you they can't. But whatever, that's my opinion. One day this market's gonna come down hard, and there's just not much they can do to stop it. All right, I think I covered everything. Did I cover the small caps? Look at IWM. Same thing, bearish rising wedge breakdown. The small caps haven't even come close to their highs back in 2015, and like everything else, you can see that where we're flirting with those previous reaction highs back here, as well as some reaction highs back in 2015. Oh, last one, and then we'll wrap it up. Wilshire 5000 again. This is really indicative of the market here. A lot of stocks in there. There's the 2015 highs, double top high, breakout, failure. Tried to get back above them, and the Wilshire 5000 is clearly rolled over. Very clean bearish rising wedge. There's some support levels. I actually have them marked up on this chart. It's about 2200 when the Wilshire takes that out, and these are my targets down here, and they would be comparable on the Nasdaq 100 and S&P 500. And I may put some of these up as static charts. I know not everybody has the time or inclination to watch the videos, but just wanted to get that out. Sometimes it's easier to get all my thoughts out in words than to try to mark up the charts and explain that, especially with those trend indicators. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it and have a great trading week.